Warren Buffett's first rule revolves around dismantling the illusion of total corporate death. When a giant corporation approaches bankruptcy, panic erupts, and the stock enters free fall on the exchange. Here, Buffett applies his famous saying, "Be greedy when others are fearful." From a business psychology perspective, you shouldn't buy driven by emotion or just because the stock is cheap. Instead, you must search for the economic moat. The mathematical advice here: if the company possesses patents or irreplaceable infrastructure, its crisis is temporary liquidity, not existential. Or if it has a brand deeply embedded in the minds of the masses, then survival is only a matter of time. Buying at the pre-bankruptcy stage requires confirming that the company's tangible and intangible assets are worth multiples of its current collapsed stock price. This makes buying here a brilliant, cold-blooded financial piracy deal. Warren Buffett has built an empire on this principle, buying distressed giants and turning them into long-term fortunes. The economic moat is your shield against permanent loss and your gateway to exceptional returns. Remember, in the darkest market crashes, the greatest fortunes are made by those who understand value beyond price. Warren Buffett's second principle focuses on cold mathematics, far from the noise of terrifying headlines. Buffett warns against being swept away by companies suffering from a rotting financial structure. The right time to buy is when the numbers prove the company can generate positive operating cash flow, despite accumulated debt on its balance sheet. Common human behavior flees the moment they hear the word restructuring, but Buffett digs into the details. He asks, is the problem in previous bad management or in the absence of demand for the product? If the product is still desired in the market and the company generates cash from daily sales but is suffocated by loan interest, then the entry of a major investor or the announcement of a protection plan like Chapter 11 bankruptcy will erase the debt and revalue the stock to rise by thousands of %, turning your small investment into a massive fortune. This is the mathematical edge that separates the panicked crowd from the strategic investor. Buffett doesn't run from the word debt. He measures whether the underlying business still breathes cash. If cash flow is positive and the product has a market, debt becomes a temporary obstacle, not a death sentence. This is how he transforms crisis into opportunity, while others see only disaster. Warren Buffett appears on screen, his sharp gaze piercing through the camera. This is his third and final piece of advice. Buffett's third principle focuses on the human and behavioral factor in crisis management. Warren Buffett never buys into a dying company if the old management that caused the disaster still holds the reins. The perfect psychological moment to buy is the moment of beheading the snake, when the failed CEO is fired. A new board of directors, known for its ability to rescue companies, is appointed. Or when signs of turnaround management begin to appear in the company's operations. This moment delivers a positive psychological shock to the market, a cognitive shift from fear to cautious optimism. The investment here is not in the current collapsing numbers, but in the psychology of new confidence. This confidence is injected by the incoming management, transforming dying assets into profit-generating machines. It is the most precise timing, the moment when assets on the brink of extinction become investment gold. This is Warren Buffett's legendary investment timing, turning catastrophe into historic financial returns. Follow us for more.